So Liz, thanks for joining us today.
Yeah.
It's really great to have you here to talk more about what's going on in the lending environment. You and I have known each other for a long time, back to high school days.
Yeah.
And I've seen your career grow and blossom over the years. I've been really impressed by the work that you've been doing.
Thank you.
Help get people connected with the funds they need to get into the homes. But you've made some big changes recently. You were working in an independent brokerage and you went to Maine State Credit Union, right?
Yeah. So I recently joined Maine State Credit Union. I'm their Senior Vice President of Mortgage Lending. So it's a little bit of a change for me. I've stepped out of production and really am going into trying to create an environment, a lending environment there that meets the needs of Mainers. And so finding these holes of different types of financing that people are just having a hard time obtaining through secondary market. So it's been really fun to kind of step into the portfolio side of lending.
Yeah, that's great. So you don't work all the time, right? You've got a family that's growing.
I do.
Tell us about that a little bit.
Yeah. So I live with my husband right in central Maine, and we have 2 kids, 13 and 11. A boy and a girl, and we've got 3 dogs and a bearded dragon. So we are very busy. We're all over the place. I feel like we love to travel and have sports, every night, every weekend. So we don't sit still for very long, but we love it.
Yeah, for sure. Well, I mean, you get to see firsthand the importance of having good housing options in central Maine. And I think that it's probably the goal of most parents to figure out a way to keep their kids here around, after they grow up. But oftentimes it seems that there aren't as many opportunities in Maine, And I'm wondering, what you think about this idea of a lot of those opportunities being driven by housing options. I mean, I've felt for a long time that many people move away for education and they want to move back and make Maine their home, or maybe they never wanted to leave to begin with. But a lot of the calculus is, what's available for housing options and what am I going to be making for a wage and do they add up? And so I guess I would ask you this, what do you see in terms of your interactions with, and maybe this is a little bit more in your previous role, but still now taking that to the forefront with development of programs in your new role. I mean, what are some of the challenges that buyers are running into, here in Maine with buying?
Yeah, I think, the top of that list is inventory, right? People want to stay where they are because they have a 3% interest rate. And what that means is any step-up buyers, they're not stepping up yet. They're not moving into that newer home for their growing family. And so those first-time home buyers are just having a little bit more of a struggle entering the market. You put that together with affordability. Rates are higher than they have been over the past, 10-ish years. And so those people, those first-time home buyers, they're now entering this market and everybody is telling them that the rates are so high, right? And so that's the headlines, that's the news. When you actually look at historical rates, yes, they're higher than they were 3 years ago, but they're not that much higher than they were 4.5 years ago. It's just the context of how people are getting that news delivered to them that I feel like is really making them feel anxious about entering the market. Also, inflation. The reality with inflation is that people are waiting for prices and goods and all of these things to come down, and that's not going to happen. There's a difference between deflation and disinflation, right?
Can you explain that a little bit more?
Yeah. So deflation is that something gets inflated and then it comes back down. So the home values, right? Everybody knows that there were so many people that were trying to get into the market when rates were so low, and it caused bidding wars. It caused, homes being sold for more than their actual value during that period of time. I hear it all the time. People say, I'm going to wait for home prices to come back down. The reality is that home prices are not going to deflate anytime soon, at least. And that's because there's so many people going into the market. Disinflation means that inflation is going to stop rising at a rapid rate. Things will still increase as wages increase and as people change how they're buying, but the rates themselves, or the home values themselves, are going to continue to rise, just on a much flatter curve than going straight up. So it'll be like that with all goods.
Yeah. So not this hockey check mark, if you will, but instead a more of a flat, gradual increase in pricing over time, largely driven by low inventory.
Correct.
Yeah, and strong demand still being there.
Demand is there. We have so many people who have been in the market and looking for homes over the past 3 or 4 years. They're discouraged. They're frustrated. They're mad that they didn't get the home when rates were 3%, right? But the reality is there's probably a more reasonable influx of, there's a more reasonable increase or average of the average sale of a home now than what we were seeing last summer and 2 summers ago.
Yeah.
But as soon as rates trickle down even a little bit, every time they drop just a little bit, you're adding hundreds of thousands of more people back into the housing.
Can you explain why that is to people that aren't familiar with it? Is it because of the payment? I mean, it must all kind of come down to the monthly payment.
Yeah. So on the mortgage end of things, we're going to not calculate based off from the dollar amount that you're borrowing, but based off from how everything kind of compiles and adds up to make your monthly payment. So we take into consideration your taxes of the property, insurance, your purchase price, your down payment. We take into consideration all of that. And that is not going to be the same. Every house that you look at, that's $250,000. That's going to, that is going to be impacted based off from some of those other factors. When you drop the rate by even 1/4% on an average of $250,000 purchase price, you're probably looking at that home buyer with a 1/4% deduction in rate. They're probably saving $75 to $80 a month. Really? And so if they're thinking that they're tapped out on their maximum purchase price of a home, every time that interest rate ticks down just a little bit, their maximum purchase price goes up. Their affordability is still, let's say, $2,500 a month. That continues to go up. Now it's a $300,000 house because rates are 5.5% instead of 6%.
So it sounds like to me that, to use a sports analogy, that the football game is still being played out, right? We got the Super Bowl coming right up, and it's going to be exciting. But when you watch the game, there's a ton of people standing on the sideline, right? Each with different capacities and capabilities. And during the game, sometime comes up that that person's capacity and capability matches with the need that's out on the field, and they get called out. So to me, I think about the buyers that are on the sidelines right now. They're like, hey, coach, call on me. And coach is like, sorry, you're only approved for $250,000. You know, there's nothing we can do about it. But now if the rate goes down, let's say 0.5%, maybe they're approved for $275 now instead of $250. And they're like, hey, coach, I want to play. And they're like, oh, this is great. We've got one for you at $270,000. It's on the market. Now you're a buyer. They were always a buyer, but they were made then a more legitimate buyer by the fact that the rate came down and the prices are now in line with what they can have for a payment. It's been interesting to see how quick prices have rose because of the low rates and the interest, but also paired with just really low underbuilding in this country, which has been happening for decades. It's something we talk about a lot at Pouliot Real Estate. You know, we have our tagline, selling homes, building community. Building community, important on a lot of fronts, but also on the front of housing creation. Because I think the only way that we're going to get out of this is to see an increase in inventory at the level at which people can afford, and that's kind of the rub.
Yeah.
You know, it's like, okay, there's nothing out there for me and my price point. What do I do? Nothing? No. Why don't we look at building? Okay, look at building. It still is too expensive.
Yeah.
So there's either going to have to be a drastic increase in inventory or a change in expectations as to the size of home that people get, right?
Yeah.
Because I think that a lot of preconceived notions about what people could afford have been built on just years and years of buying existing inventory and rates being at a level that, I shouldn't say years and years, but at least the past few years, rates being at a level where people could afford more home, and now they can't.
I like to talk, when I'm talking to my buyers, I am having conversations with them about like, what's Instagram and what's reality.
Yeah.
And I know that that's kind of a very millennial thing to say, but the reality is that you have these people all over the internet and they're saying, look at my first home, right? And it's a 3-story beautiful farmhouse, right? And they have the farmer's porch and they have the pool in the back and they have all of these beautiful, beautiful components to a home that hopefully I get someday, right? Mm-hmm. The reality is that that's not your typical first-time home buyer. I know the house I first lived in, my first home, my first apartment, it was very far from being Instagram worthy. People's expectations need to come down to earth a little bit. Because what you can afford as a first-time home buyer or coming into the workforce with student loans, right? When you're coming in, like your affordability is not going to be $500,000, and that's where these lowering of interest rates paired with kind of that more flatlined home price, which we should be able to continue to see for a little bit at least, you're getting buyers that are looking in that lower than what would be average purchase price. And right now the inventory in that arena is hardly livable, if I'm being honest, right? That's very far from being Instagram worthy.
Right.
So, yes, I want people to kind of lower their expectations of what having a first-time home, that first-time home buyer, what that home looks like. But also, you and I both put sweat equity into our first homes, right? Yeah. There's work that can be done with those things. And so pairing loan products or that can foster some renovations to create something that's a little bit more Instagram worthy, right?
Sure. Yeah, because you probably run into people who would want to take a property that needs some more work, but then the loan product that they're qualified for says, no, you can't do that. Yeah. Or you've got to do maybe like an FHA 203K type loan, which seems daunting to some people, and so they don't pursue it. And so it's not a lack of desire or ambition maybe on the part of the buyer, it's just a lack of understanding programs. What it's going to be like. Yep. And it sounds like you're working to try to create some more programs that be just easier for the consumer to use.
Yeah, I think, I've run into so many people that have had that struggle, right? They want the beautiful house. They want the old home even, right? We have a lot of these old, big, beautiful homes in Maine, and they require some rehab, and in some cases, very specific types of rehab. And again, the cost of nothing's free. So pairing that with, okay, you can get this home for $200,000, but it needs about $75,000 worth of work. We have purchase plus improvement programs. We have construction programs that can kind of help foster some of that renovation. And not only does that help that consumer at the time, it also helps revive our community, right? Yeah. Which is a beautiful thing when you see that house on your street come back to life, right? So there's a lot going on in the market right now, and there's also not much going on in the market, if that makes any sense.
Yeah, no, it's true. It seems like a lot of the properties that we have, even a few properties of our own that maybe haven't sold as quickly, and when I look at why, it comes back to the same primary thing with all of them. It's condition of the property. And I think a lot of consumers, particularly maybe our generation, millennials or Gen Z, are like less inclined to want to maybe do as much work because, you know, we came about at a time when home ec and the trade programs were kind of being taken out of school, right? And so we didn't see it as much. And then graduating from college, a lot of folks, you know, around the Great Recession thinking like, hey, probably the trades isn't a great thing to get into. And I also don't know of any of my friends that are in the trades. And so it makes it harder to really get into doing work or fixing places up when you don't know who's going to do the work, if they're going to be reliable, if you can trust them. And I think that this is what we're seeing is, you know, we need people to come to the table that are willing to take some of these properties that are in rougher shape, get paired up with a loan product that makes it easy for them to get the money they need to do the work, but also have connections with people that can get it done. And that seems to be like one of the disconnects in our area with the second oldest population in the United States, finding tradespeople to get a lot of the work done. Do you ever, I'm curious, talk about at the credit union about building out, or is there a network of tradespeople that can do some of this work for people?
So one of the things that we've recently implemented is an approved contractor list.
Okay.
And so similar to how we check credentials for a borrower, right? We get their credit score, we get their financials, we understand what their financial position looks like, right? One of the things that why banks and you know, any lending style doesn't want to lend money in those instances is because there's a lot of risk. You're not just lending money to that borrower that's agreed to pay it back. You're writing a check to somebody that in the state of Maine doesn't need to be licensed, right?
Right, yeah.
And so we've started this process where we go through this approval process with contractors, and a lot of contractors initially have a little bit of pushback, right? Why do I need to provide you with I'm not even doing work for you, I'm doing it for them. And I present it very similarly to why they ask for somebody's pre-approval letter, right? You've been given that, you've been granted that information from this consumer that they are qualified to borrow money, that you are the one that's guaranteed to be paid. Why would we not, before we cut you a check, verify that your financial situation and that your business is thriving, or at least meeting the, you know, the very minimum basics of a business that can function? You know, if what we're finding is that if contractors are going to push back substantially, it's not somebody that us as an institution want to work with.
Right.
And it's also probably going to indicate some future behaviors during that rebuild or that rehab process or the, you know, formal build process. So most of the time, in most cases, when we have that conversation with contractors, they either get it or they're ready to walk away. And that's because typically there's either something to hide or they genuinely just, it's against their beliefs of how they want to run their business. I'm totally fine with that though.
Yeah, I mean, so if there were a consumer out there, buyer, that were to see this and say, hey, look, you know, I'm interested in buying a home that needs work. I have a full-time job. I've been there for a couple years. It's pretty stable. My credit score, I think, is all right, but I have no idea. I haven't looked at it in a while. I mean, what would the process look like in order to be able to buy a home like that needs work from your institution's perspective? Yeah,
so what we typically start with is, there's a home that you are looking at, do you understand the scope of work? You know, do you really understand what needs to be done to that home? Sometimes it's not a critical item. Sometimes,
I guess I would say this. What if they say, I have no idea, but I'm willing to do it?
Yeah.
What do you know?
Yeah. So our process on our end would look like we would have that consumer work with a contractor to decide what that scope of work looks like. Once we can target sort of a price point based off from quotes or based off from information gathering phase, At that point, then we verify that they can even be approved for it, right? So if they want a $200,000 purchase price and they want to put $75,000 into it, we want to make sure that they're obviously approved for that $75,000 to borrow on top of that $200,000 price. So we will understand the scope of work, and then it will fall in line with either a purchase plus improvement program, or it would fall in line with our construction program. So the larger type of additions, garages, full-blown rehabs, those are all going to be on that construction side. Some basic improvements, like maybe they want to buy a home that doesn't have a functioning heating system, or maybe they want to buy a home, but a contractor walked away midway through, or somebody who thought they could flip a house couldn't finish it, right? Which has been happening. We see people walking away midway. So at that point, we would take all of that information, we would find the best program for them, and then we would go through that sort of approval process with the contractor that they had chosen, or we would have a list of contractors that we could provide to them that have already gone through some of that, so that it could help make that process a little bit faster for them.
So it sounds like if somebody has an approval for a loan, but is not finding anything out there that is kind of done, if you will, more turnkey, that there are options for them to be able to buy homes, get them fixed up, and then still do that under just the one loan payment product. Would they have to have 2 loan closings, or do you just close and the money gets escrowed and you pay the people for the work?
Just like that.
Oh, cool. That's great. Yeah, it really seems to be that there isn't a shortage of demand, and there is certainly a shortage of inventory. And so one way that we can add more inventory is by taking an existing home and fixing it up to meet the needs of somebody. The other way is really kind of like on the new construction front. I'm curious what you offer on that front, and kind of how the process works in terms of a loan closing. I mean, does somebody, if they want to build a home, do they close on it and have to start making payments when the foundation starts getting dug, or is it something that starts when it's done?
Yeah, so we do a one-time closed construction loan. And so we closed prior to, in most cases, any work being done on the property. And it begins sort of a 12-month building period. So within that 12 months, there's a determined amount of draws that they can pull from their approved amount. And typically, you'll do the first draw on maybe some earthwork and foundation, right? And then maybe the second draw is to get some larger materials to the site. Third draw might be when the home is weather tight, and so on. As every draw gets taken monthly based off from the amount that's been drawn on, you'd pay interest only during that period. Really, the whole idea of that is understanding that they have to live somewhere, right, during that period of construction. So we want to make those payments as low and as reasonable as possible for them. So we do interest only during that period. And then right at the end of the process, once we have certificate of occupancy and we have them, all signed, sealed, delivered, the home is ready for them to occupy. At that point, it turns and rolls over into a fully amortized, normal fixed rate loan. So
that brings up a question that I have, which is, let's say, and we'll try to keep this as simple as possible, but let's say you have a buyer who is qualified for up to $300,000, but when you did that qualification for them, the assumption was that that's going to be their only housing payment, if you will. So now, in this scenario that you've described, there's an opportunity for them to build something else while they're living where they are. That's great. That's a way to get more inventory out there. Maybe they own that home, maybe they rent it, doesn't really matter. They're getting their next thing started while they're still living there. So are you running that pre-approval based on their current cost of living plus that interest-only payment? And how often, if ever, does that prevent somebody from being able to move forward?
So construction in general is sort of a reserve-heavy type of a loan product. And what I mean by that is we're going to check to make sure that they've got money in the bank. They have reserves for some things like cost overruns on the construction product. That's not unheard of, that something ends up, costing more than what you thought it would,
Yeah,
or
all the time.
they have to drill the well a little bit deeper, and that costs more money, or there's ledge when they're trying to put the septic in. All of these things are real, true Maine issues that people run into, right? And so being sort of contingency heavy, we hold back a 10% reserve. So most banks, credit unions, anybody that's doing construction lending is typically in that 5 to 10% range of contingency. As a part of that contingency, I also, in my mind, consider that to be how they're going to be able to cover kind of both of those payments over time.
Okay.
So yes, I want to make sure that their income can support and make sure that they're not, their debt to income is still reasonable during that period of time with both of those costs.
Yeah, because that's what I'm kind of getting at, thinking in my head. I'm like, all right, somebody's approved for 300 because the debt to income ratio would be, say, 30%.
Yeah.
But now with this interest only payment of maybe it's $500 a month, now their debt to income ratio is 40%.
Yeah.
And are they a big red X, or are they still, hey, we're going to work with you because we recognize that once you're done with this house, that additional 10%, if you will, is going to be gone because you're going to get rid of your other expense.
Yeah. So we look at it more in an all-encompassing type of a way, where we want to make sure that they have some money in savings, obviously.
Yeah.
And
it brings up a good question. Like, how much money? Let's say someone's like, I'm living in an apartment. I want to build my first house. I don't want to go try to buy one. How much, and then let's say that they were approved for up to $300,000. I mean, how much cold, hard cash do they need to have to be able to do this?
So if they are going with a construction loan for that process, they're going to need 10% down.
Okay.
So they would, in this case, $300,000, they would need $30,000.
Yeah.
And then they would also have a 10% contingency. So we would want to make sure that they had assets of 10% or more available to them should there be any cost overruns.
One of the things we're trying to work through is a way in which people can think about or utilize modular as a way to build a new home at maybe a lower cost of cash outlay to them, which seems to be, I don't know, correct me if I'm wrong, I've been at this for, almost 15 years now, and it seems to me that the primary reason why people don't pursue building a new home is primarily, one, they don't have enough cash to do it, or they think they don't have enough cash. And I think that's an important thing I'd like to talk with you about. And secondly, they just have no familiarity with building. They don't know a builder. They don't know how it's all going to come together. I don't think in either of those situations exists that somebody doesn't want to do it. It's just they don't know how, or they think that there's no path for them.
Correct.
So I'm curious, like, on the first point of how much money they would need to do this. Through a traditional lens of building, it sounds like people more or less need about 20%, either assets or actual cold hard cash. But it sounds like if somebody were to utilize a modular home, which is still a brand new built home, just in a factory instead of on site, that you only would need less money down to be able to do that.
Yeah. So it also depends on, like I said earlier, it depends on what type of financing they're going for. So is it a true construction loan, or is the manufacturer, or the modular home company going to do all of the work and then just get paid and have their check written at the end?
Yeah.
Right? So that's going to be the most affordable for the borrower, but it's also a lot of out-of-pocket cost for the modular manufactured home company, right? So a lot of times what we're finding is most people feel like they can't do it, and so they're in their mind they have to go with the construction route, and that construction route, specifically with modular, we do your down payment, which is 10% for a construction modular, and then you would have to have 5% somewhere liquid, liquid assets. So something that you could draw on. So a 401k, as long as it's vested. I feel like that's like the one thing people forget because they feel like they can't touch it.
Yeah.
But a lot of people have some money vested in a 401k.
Yeah.
And so worst case scenario, there's some cost overruns on their deal. They did hit ledge, or the driveway or the power costed more than what they thought it was going to be to get that to the property. And so in those instances, we would have them draw on their 401k with whatever penalties exist for that, which oftentimes there's not any, because if it's your first home, you can borrow or withdraw from your 401k with very limited penalty. So that's a great utilization of why we save our money, right?
Yeah.
Having an asset that will appreciate over time is exactly what we hope for our 401k. So it's not necessarily this mismanagement of money.
Right. You're buying an asset that will appreciate.
You're buying an asset that will continue to appreciate, just like the money that you're putting into your 401k and hoping that it appreciates, right?
Right.
So that's typically what I lean on for asset reserves. So even in the case of the renter, right, who has to manage renting during the period of construction, or during that period of having two places that they may be paying on at least a little bit, it helps offset by having that 401k or an IRA or something that they can draw on. So.
Yeah, I think that's an interesting point you bring up. I mean, neither one of us are financial advisors, and we're not qualified to give financial advice. Good. It's important, though, to think about things through the lens of, like, what is it that you're trying to accomplish? Right. And if someone's putting money into a 401k to provide a nest egg for themselves down the road, maybe in some cases that's not altogether different than investing in a home,
Correct.
Which is going to appreciate in some cases much more than what's going on in the stock market. I'm really intrigued about that approach of, like, utilizing the 401k for people, and I think that that's a great solution. So it sounds like if someone were to say, hey, I want to move forward with building a new home, they need somewhere around 15% if they go a modular route, but really only about 10% cold hard cash. And then the rest can be, other sources that are maybe liquid in nature, but they don't need to be brought to the closing table.
Correct.
Okay.
Correct.
That's super helpful. I mean, I think a lot of times people feel like, hey, this isn't for me unless I've got 20% to put down, which with student loan debt and all this other stuff going on, most people just don't have it.
Yeah.
Yeah.
One of the things I feel like we see a lot of is my parents want to gift me land, or my parents want to gift me, or any family member really wants to gift me money towards they see how much I'm struggling finding the home that I want to buy. And so they're willing to help me in some fashion. And so we have some rules around gifting of assets and gifting of land. However, it does add another component to some flexibility with consumers, specifically in the state of Maine, where our family members tend to have some land or maybe a lot of land, and it's easy enough to, carve out a little piece of that heaven for a family member. So that's another neat component that we can use, and we can use that as equity in the property.
So if somebody, let's say their grandmother had a 30-acre parcel of land and it's got a 500 feet of road frontage, and the town requires 200 feet to build on, so the grandmother's like, hey, I'm giving you this 200 by 200 parcel over here on the corner, and an assessor goes out there and says that land is worth $45,000, and the person wanted to build a $300,000 house. Could that $45,000 be used as their 10% down payment, or does it have to still be cash?
So it can be used as a down payment. The way that it's not formally called a down payment. However, the reason why it's not formally called a down payment is because we're still using the overall appraised value. Okay. So it's not a direct $300,000 cost for building and $45,000 in value of the land to make up $345,000, right? Got it. However, if the whole property encompassing, ends up being valued at $330,000 or $333,000 or whatever it is, then that would be considered that 10%. And that would be added. So all we would need at that point would just be contingency. So not cash to bring to the table, but just money that would be available if there were any overruns. So that's a great question though, because we see that a lot. Or somebody that has bought land, they bought land a couple of years ago for hunting. And now they're thinking, you know what, I'm just going to build something on it. We can take some of that equity out of that property, and it can act as a form of down payment as long as the equity is still there in the overall encompassing build cost.
Yeah. So it sounds like there are some good options for people on that front.
Yeah.
Great. It's my perception that a lot of consumers feel that they need to be actively engaged in buying a home before they could reach out to a lender. But it seems to me that you have a lot of value to add before somebody starts the process of buying, or maybe even perhaps before they have even talked with a real estate agent. And it seems that through a lot of cases that I've found, people, once they talk with a lender, they open up a lot more to like what the possibilities are. Can you talk a little bit more about the importance of, creating a relationship with with a lender and exploring that process, before people get started with working to buy a house?
So many times people don't know who to turn to because they don't know who to ask. And I think that has everything to do with how you connect with people, right? And so if you have somebody that comes to you and says, Matt, I want to build a house, and you say, can't help you, don't know how to build, right? People feel like that's going to be how that conversation goes if they ask that question. What you do to add value to your relationships with your clients and with your community even is you may not know all of the questions to ask that person, but you know exactly who in the community can help them, right? And so I always think about that, like, how can I add value to my relationships with not just my referral partners and not just my realtor friends, but also I have friends, I have family that reach out to me and say, hey, my son wants to buy a house, and I don't know how to buy a house. I haven't done it in 30 years. How can I tell him what to do? And I feel like, first of all, that's like my favorite form of flattery is when people ask me for help. I love that. Yeah. But I also think that it just goes into making an impact and being resourceful, and being a resource for people. I feel like relationships in general and trust that gets built in those relationships, trust in its most primitive form, right, is based off from authenticity. And it's not necessarily based off from flawlessness. It's not based off from somebody that never makes a mistake, right? It's based off from getting heartfelt information delivered to the people that we care about. And that's where you and I align so well, Matt. Like, we both look at our community and we see people that we went to school with. We see people that we see every day on our lunch walk. We live, work, and play in this community. And so having that development of trust and not a false, it's not false, right? It's very authentic. We really do want to help people. And so I just think that's the most beautiful part of our jobs.
Yeah, people do business with people that they know, like, and trust. And so our role obviously is kind of being out in front of people and being a part of the community is a twofold benefit, really. I mean, you're helping people be mindful of the fact that you'd like to help them when something comes up, if they feel it would be a good fit for them. But more importantly, there's a benefit going on to the community as well. So people can see which is true. I mean, you know, there are probably people out there that get into different things because they're like, oh, how's it going to benefit the business? And it's more like when you're doing things because it's what you naturally love to do.
Yeah.
And then, oh, by the way, it happens to benefit business too. That's kind of, in my opinion, really a true win-win.
Yeah.
And how we can really build on that authentic, you know, desire to really help build community, improve the lives of the people that live around us, and at the same time, you know, be able to do business together too,
Right.
you know?
Right.
But I think oftentimes people start, especially in this, you know, quick culture of everything, trying to keep up with the Joneses, with trying to go out and look at making money first. And it's important to make money, but the money will come in time if you just continue to do the right things.
Yeah. As long as, you know, revenue comes, you know, and goes sometimes. But as long as you're doing things for the right reason, I believe that that will always be something that finds its way to you for doing the right thing. Specifically in this industry. People talk. People talk a lot. And so, you know, even if you don't wrong your neighbor, but you wronged somebody that's further down the street, your neighbor's still going to find out about it.
Right.
You know?
Yeah, it's so true. I mean, it's important that our industry is such a significant part of, you know, the overall economy in Maine, but also a lot of times we're helping people with their most valuable financial asset. And that's really, I think, important to keep in context. It's like, well, the advice that we give to people, whether buying or selling, is largely going to determine where they land financially as a result of that, you know, interaction. And to me, that's like a tremendous amount of responsibility because, you know, we live in a country in which it's still a meritocracy, you know, and a lot of that's based on what people have for financial wealth, you know, and this is a core component of that. So it's not something to be taken lightly. I think, you know, a lot of times the big struggle for us is trying to find things that align with what, you know, people can afford and so forth, not necessarily the desire of people to own a home, you know? And I think we've got a lot of work to do on that front of creating more opportunities and getting creative in finding ways for people to get the home that they need so that they can stay and live and thrive in Maine.
Yeah.
A lot of times people are already working with a real estate agent when they come to see you. Sometimes they aren't. But can you talk a little bit about the process and the benefits maybe that you've seen? Some people probably have bought homes without a real estate agent and come to you directly, but maybe the benefits of working with a real estate agent and how for you as a lender, maybe sometimes that makes the process, does it make the process easier or does it make it harder? I mean.
So I talk a lot about authenticity and I talk a lot about trust. And I feel like if I have to let somebody down for whatever reason, whether it's I don't offer the right product or maybe I'm busy, right? Or all of the reasons why sometimes friendships don't even work out, right? I find value in working with people in this industry that I like. And I know that seems like such a little nuance. Why do I have to work? I don't have to like them. I just have to, I need money from them or I need the realtor to do what they do, right? But this is a really high stress type of a transaction. And so if you work with people who you trust and who trust you, that process becomes a lot more simple for everybody. If you and I are working together, Matt, I know that you're on your end and you're going to be doing the best job that you can do for that member that's working, you know, that you're working with, and you can trust me to do my job. If you're working with an online lender or, and that's not a dig at an online lender, they certainly serve a purpose in this world, but if you're working with just anybody and you don't have a relationship, if they have to do something or they don't do something and it lets you down, they don't care, right? I have to see you at the grocery store. You know, I have to see you at the basketball game or, you know, I have to wave to you every morning when you're leaving for work and I'm on my way to work, right? And that's the reality, is that when we have a relationship that I'm more naturally going to jump through hoops to please the people around me because I like them and because I know that their livelihood might be based off from a transaction that I'm doing. And I just don't want to let you down. I'm not even necessarily a people pleaser, but I want to do what's right for the people that I work with, the people that are in my community. And so there's a huge benefit to knowing who you're working with and knowing that your values align.
So I'm curious, you've been doing this for a long time and you've helped people with probably, I'm guessing, thousands of loans.
Yeah, at this point.
I mean, you must have some stories about people who really probably thought the end was near and you were able to figure out a way to kind of get it done for them.
Yeah, I mean, I feel like somebody in their most vulnerable state is when you get ready to pull their credit, right? They just start sort of throwing all of these scenarios out there. That one missed payment that they made 6 years ago, or that one medical bill that got through to collections. And so I always try to make people feel obviously very comfortable throughout that process, but credit is not the only reflector or the only reflection that we can look at to somebody's ability to obtain a mortgage.
Really? I thought like that was a stopper.
No. So one of the most beautiful things about where I'm at now and being a portfolio lender is there's some flexibilities there, right?
I want to just pause for one moment before you go on with the story of how you helped.
Yeah.
The difference between a portfolio lender and a secondary market lender, like real quick, what's the difference? And maybe some of the benefits.
Sure. So a secondary market lender is going to be somebody that is taking a subset of rules from somebody else that is willing to lend the money, and they are throwing those rules at the consumer and at the lender themselves and saying, hey, you need to follow, you need to check all of these boxes.
In addition to what the feds already require.
Correct.
Okay.
And so we call those underwriting conditions, right? They're overlays of rules and regulations that you have to meet in order to meet certain program guidelines through like government loan programs and stuff like that. A portfolio lender is lending their own money, and so they get to make the rules and make decisions based off from their best interests. And also in our case, it's our members, right? So these are, a credit union is member owned. And so we try to, look for reasons to say yes to our members. And in doing that, you may have that member that has a lower credit score, or maybe their credit score is just fine, but maybe they did file for bankruptcy 2 or 3 years ago, and it's some step that they need to get over. Secondary market might say you need to be 7 years post bankruptcy in order for me to lend to you. Whereas a portfolio lender can make a decision and a thoughtful decision based off from the circumstances of what actually brought on that bankruptcy to begin with, but then what have they done since that bankruptcy to help sort of allow us to the opportunity to say yes. So that brings me to our very recent member of ours, and he had gone through a bankruptcy 2 years ago. And he, about 7 months ago, he came into the credit union and he said, I need a place to live. I want to have my own place. I have an opportunity to purchase this place that I'm renting. And I'm afraid if I don't buy it, then I'm not going to have a place to live because I have this bankruptcy that's sort of looming over me. His landlord had said, talk to your bank and let them, ask whatever questions you need to and see if they can make something work. And he came in very much like, I don't know why I'm here. I know you're going to say no. And I love to just say challenge accepted, right?
Yeah.
My goal is to never say no. It's to say, hey, let's put a plan together.
Right.
And we'll follow through with this plan so that we can get to that yes. And so in this instance, we were able to do a couple of things to help obviously increase his credit score. Going through bankruptcy is not easy on your credit. So we increased his credit score. He had 6 months of on-time payment history with a secured loan that we did. And on a older car that he had, we were able to kind of make some adjustments, improve his credit to a point where we could use it on the mortgage side. And then the only exception that we made was that he had a bankruptcy that was within a period of time that we wouldn't typically lend.
Yeah.
But because he had followed through with the plan, it made us feel like we were in a comfortable enough spot that we could proceed for him. And so he closed on his home in December.
Wow, that's cool.
And was able to spend Christmas in his own home instead of in the home that he was renting.
That's awesome.
We want to say yes. And some people want to say yes for revenue. And we all love money. There's no denying that. But when you're saying yes because there's livelihood on the other side of it and that there's comfort on the other side of it, makes it feel a lot better.
Yeah, for sure. I mean, it's interesting you tell that story, and when you said he was able to experience it for Christmas, that really it makes the hair stand up, in the back of my neck, because that's the business that we're in. We're in the business of security, in my opinion.
Yeah.
Like home security and feeling safe. For a lot of people only exists at home. And when they don't have a home or a home that adequately meets their needs, there's so many other negative impacts that could happen in their life, not the least of which just stress alone can be toxic to people. So it's more than just helping people buy and sell homes. It's helping people buy and sell better living environments where they can hopefully have a better quality of life. It's interesting to me because I would imagine there's many people out there who think, well, I don't even know why I'm here. This is a waste of time because of ABC. And what it sounds like is if somebody can become a member of a credit union, specifically Maine State Credit Union, that you have the flexibility to go in and work with them. But that raises a question, who can become a member?
Yeah. So we are, based off from our footprint in Maine, we have 9 or 10 counties in the state. We're heading towards 16 counties here very soon, but for the time being, we have 9 counties that we cover. So we've got 5 branches, and really anybody can come in if they live, work, or worship in any of those counties.
Oh, okay.
And so we'll get your
Do you ever have
membership.
anybody that goes to a church just to be able to get a loan from you?
We have had that happen, actually.
That's interesting.
And, or they have family members that are in these counties. And so...
sounds somewhat flexible.
Yeah. I mean, we that's our goal. We're Maine State, and I feel confident and secure that we're serving a lot of different people throughout the state. So earlier you mentioned feelings, right? And we're not selling homes, or we're not mortgaging homes. We're not, we're in a business that it's not the sales and the service that we're doing that matters the most. It's the feeling that the people get and the value of that feeling, right? And so I always think like this, when I have people that are discouraged about finding their home, I always try and remind them that it's just not that, that home wasn't the right home to fit their Christmas tree that they were so excited to put in their window, right? It wasn't the perfect window for your Christmas tree, because I'm tying into what they're saying that they want in their home is they want that place that they can, trim the perfect tree, right? That's the value of getting to know our clients and getting to know our members, is being able to help guide them through what is a struggle process. It stinks. It is horrible to put 7 offers in on properties that you sort of like and still not get them. Right? Yeah,
totally.
And so when we tie feeling into it, it makes all the difference.
Yeah.
It also helps ease some of that disgruntledness going through that whole process as well. So
sure. Yeah, I know it's really important to have that relationship and have having one with a credit union that is a portfolio lender can make it easier to navigate some of these things that inevitably come up in life. And so it seems like the effort isn't just let's see how fast we can get them a loan and move on to the next one, like some of these national companies that you see advertising on TV. It's more about, hey, what's going on for you? Where can we help you, serve you the most, you know, and create a client for life through that relationship.
I'm a big proponent to when people come in and they're flustered or they feel like they aren't ready to buy or they feel like they don't know if they'll be ready to buy. I always tell them I'm your coach, right? So I'm here to help guide you through this process in a way that makes you feel safe, happy, and supported until you get to whatever that finish line looks like, you know, to the championship of home ownership. So our goal is to coach, and it doesn't stop once you secure your mortgage. You've now accumulated or you've now purchased your largest asset that you're likely to purchase in your whole life. Now, what are you going to do with that? We have further questions, right? We have further things that need to take place in order for you to secure financial security moving forward in your life. And so that's kind of the fun part of being at an institution where we offer savings accounts and we offer, auto loans, and we offer all of these different components that help people retirement accounts. We help people make smart financial decisions, not just leading up to them purchasing their mortgage, but they have to pay it for 30 years. So we want to make sure for the next 30 years that they're taken care of financially to make those smart decisions. And so we're your coach. I love that.
I think a lot of times there are people out there, and we talked about it a little bit already, that don't really see themselves as a buyer. And one thing that I've encouraged people to look at in the past, and I'm curious what you think about this, is, hey, look, you're a first-time buyer. You don't have a tremendous amount of income. However, are you open to the idea of being a landlord? And most of the time they're like, well, I don't know anything. I've only heard horror stories about renting. It's horrible and the world's going to end. And it's like, well, you know, eventually it will, yes, but not if you buy a multifamily.
Right.
Here are some things to consider. But I'm curious, let's say you've got a first-time buyer. They don't have a huge income, but that multifamily that they want to buy, once they are allowed to become the owner, vis-a-vis getting a loan from you and closing on it, they're going to start getting paychecks in the mail, right, in the form of rental income. How does the bank look at that? Will they qualify somebody based on that as opposed to what they're making at their W-2 job? And should people who are listening to this or seeing this or know someone that's looking for a home be thinking about, hey, I could get into a multifamily now because I can use that income? Should they be thinking that way, or would that be a false thought?
No, I love that question. So one of the easiest entry points into home ownership right now, specifically for first-time home buyers, is going to be using rental income to help them through purchasing multi-units. So a 2 through 4 family multi-unit, what we do is we take market rent, which is determined by an appraiser, or current leases, if there are applicable leases on the property. And we would take rental income from any of the units that aren't being occupied by the person that's purchasing, right? And so if it's a 3-unit primary multi-unit purchase, then we would take 2 of those units. One of them will be occupied by the new owner, and 2 of them we would take the income from those, and we would add it to what is their W-2 income. We only use a portion of that income, so it's not a dollar for dollar, but that's the reality of owning a multifamily or a home ownership in general, is there's always going to be some expenses. And so what we do is we take 75% of what that rental income looks like. For instance, if you were to make $1,000 in rental income out of those units, we would use $750 of that. We would add it to your already W-2 income. And in some cases, I mean, that pays for the entire mortgage. It pays for a portion of that mortgage.
Or the taxes and insurance. So that comes out of the calculation.
Correct.
Yeah. So it sounds like for someone that's willing to take the risk, whether real or perceived, to become a landlord for anywhere from 1 to 3 units, essentially. That there could be a huge upside for them in terms of what they can afford to buy.
Correct. It has been that easy entry point into homeownership because of affordability, right? So multifamilies are not inexpensive, just like a regular single family home are not inexpensive.
What I'm hearing from you is if somebody is interested in buying a home and they've met with the lender and the lender's like, sorry, all you can afford is $200,000, and they look around and they don't see any homes that they would want to buy for $200,000, and then they get some pricing on maybe building something and that's not an option because it's over $200,000, they should maybe consider looking at a multifamily building in which they could occupy one of the units and rent out the others. It's not as private, maybe not as ideal in terms of what they would want in the long run, but it could help them have a place to live and start building equity. And then down the road, right, the bank could use that towards income that they're showing toward qualifying with something else. And then if they move out of that apartment but keep the building as an investment, you can use the income from that other apartment that they were once living in, right, to help them qualify. So hopefully, you know, folks will consider that as an option if they're kind of meeting an impasse on buying a single family home. It's not for everybody. I mean, not everyone's probably wants to raise their whole family with a bunch of kids in a building with other rentals around, but.
No, but also, you know, when I have some resistance to that, borrowers that say, you know, I'm living in an apartment now and I'm not interested in that. I'm not interested in that type of living anymore. I say to them, if affordability is going to stop you, you're still going to live in an apartment. Do you want to be paying yourself or do you want to be paying somebody else? Well,
that's a great way to put it because it's true, right? Now, if they are going to continue living in that same type of environment, why wouldn't they do that and enrich their own financial well-being?
Correct.
Yeah.
And that's really what it boils down to is they're stuck in their minds because their affordability level is not where they want it to be. And so they kind of poo-poo that idea. I don't want to live in another apartment. If I'm going to buy, I'm not going to buy another apartment that I have to live in. Well, occupy it for 12 months and then see what the market's doing in 12 months. You may be able to, you know, sell this. You know, maybe you do some renovations, maybe you just some sweat equity. Maybe you do nothing and your property increases by 25%, which is half of America's, you know, value of homes over the past 3 years.
So if they took out an owner-occupied loan with you and they stated to the credit union, hey, this is an owner-occupied property, but I'm going to buy it, I'm going to move into it, I'm going to live in it. How long do they have to live there to satisfy that? I mean, is it like 12 months? You don't go back and change the loan if they move out and buy a different house, right?
No, and that can be, sometimes that stuff can happen on secondary market where they get a little bit behooved when somebody's only living there for a short period of time. However, most places that kind of regulation is 12 months. So occupying that multifamily or any home, right? Even if it's a single family home, your intent is to occupy it for 12 months. And then what happens after 12 months, if you start renting that out or you start looking for your next home, all of that stuff is a benefit to purchasing that new home is you have that income that's coming in and you can also get market rent on the unit that you're going to now no longer occupy. And so it's really, you have one unit that's paying the mortgage on your multifamily, and then you have your other unit that might be paying your new mortgage. Yeah,
that's awesome. Well, we've discussed a lot of creative options for people in terms of home buying and a lot of nuances and learned a lot of things today that I didn't know, like that you can buy a home if you've had a bankruptcy maybe in the past couple of years. Don't take no for an answer, look for options and build the right relationship. How can people get in touch with you if they're interested in doing business with Maine State Credit Union?
Yeah, so my office line is 207-624-0774. Or you can call any of the Maine State Credit Union branches and they'll get you to me.
Where are the branch locations?
So we have a location in Gray, Augusta, We have a location in Rockland
Okay.
and in Waterville.
Okay.
We have a branch that's going to be opening up in early 2025 in Belfast.
That's exciting.
And I'm really excited to continue to grow on the coast, so that's really fun. And then we actually just closed on a new operations center in Farmingdale.
Yeah.
That may end up eventually housing some branch activity of some kind. So we are in full growth mode at the credit union, and that's so exciting for me. And just the plethora of products that we can offer, and the stuff that's kind of just keeps on light bulbing that we need to get on and start offering.
It seems like the theme is, creativity with the credit union. They want to be creating products that the members can use without a lot of red tape.
Exactly.
That's great.
Exactly. And we do it with a smile. And I know that sounds super cheesy, but I feel like we all go into places and we see people that don't like their jobs. I swear every single person in our credit union and organization just loves what they do. Mm-hmm. And I'm no different. My team's no different. We absolutely love what we do, and we're driven by the people that we get to help. So
that's awesome.
Yeah.
Well, thanks for joining us today.
Yeah,
and it's been a wonderful opportunity to talk with you about how to get money for getting these deals done, but more importantly, building the community and the relationships that we all need to thrive.
Yeah, thank you. Yeah. Let me give you money, right? Like that's our tagline.
That's awesome. Well, thanks for being here.